Hello, good morning to all. This is Kelvin here again, the Senior Market Analyst of OANDA Asia Pacific. Welcome to your daily dose of market insights. Today will be Friday, the 9th of February, 2024. All right, so before we start our daily dose of market insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, all good. So before we jump straight to the short-term technical outlook on the various cross assets, let's have a recap of what happened yesterday in terms of cross asset performance. So what we could see over here is that we across the board we do have marginal gains in the major US stock indices. So if you look at across the board over here, the S&P almost unchanged, negative 0.06%. The Nasdaq S&P positive 0.06%, the Nasdaq 0.16%, the Dow Jones 0.13%. The outperformer is the Russell 2000, 1.5%. And we see the rather mixed picture on the US dollar, almost sideways. We have the because due to the fact that the 10-year US Treasury yield managed to actually went back up to 4.2%. All right, so if you look at the 10-year Treasury yield over here, let me straight away jump to the FX chart so that you can see the performance of the dollar. So the US 10-year Treasury yield, it managed to actually inch back up towards the playing around the 200-day moving average. So there was just a slight gain of 3 basis points today, 4.15%. So went to a high of 4.17%. Okay, so but net overall, it's still being like trapped. It can't really break past the previous minor swing high of 19th of January. All right, at this level, which is the 4.20% over here. Okay, so that being said, because of the slight uptick in the 10-year US Treasury yield, it actually causes the dollar to actually trade slightly higher yesterday. All right, so if you look at the dollar index, it actually went up, but towards the end of the session, it managed to hit that resistance zone again at 104.30/104.85 before pulling back off, right, and trade back below this resistance zone. So overall, we see in a nutshell, the net effect of the because dollar index, it comprises of various currency, not only a single currency against the dollar. So the net effect in terms of dollar strength, it appears to be slightly muted as well, based on yesterday's price action conclusion towards the end of the US session. So with that, the spot gold was actually sideways, but managed to help above a key short-term support level. That means I'm talking about XAU/USD at 2015 level, retested the level before inching up higher to close the US session at around 2020 plus mark. But we do see a very sharp push up in WTI crude oil, means West Texas WTI, clearing above the 74.25 level, the resistance level that we highlighted yesterday, which came in line with our short-term bullish bias as well. Right. So these are the movement across the various cross assets. And some news flow on the highlight to you again is that Federal Reserve Fed speak. So yesterday we have a slew of Fed speak. So there's this guy called Barkin, who's pretty much prevalent. Why? Because he's one of the guy who is not so dovish. He tend to err towards the cautious side of the thing. So he's still painting this very cautious tone that what Jerome Powell did last week during the press conference, ex-FOMC outcome. Okay, so what he said over here is that the Fed has the time to be patient on cutting interest rate, and also he'd like to see much more sustainable disinflation. That means he wanted to see more signs that inflation is indeed starts to taper off and inching towards the 2% 2% magic target set by the Fed and the rest of the global central bankers. So I believe that most of the Federal Reserve officials' mindset is that they do not want to repeat what happened in 1.5 years ago, where they are actually too late in hiking interest rates. So this time around, they also do not want to jump the gun being the fact that too early in cutting interest rates. Okay, so this is the mentality that trying to play out. But overall, what we could see over here is that the Federal Reserve cut cycle is not totally dead for 2024, it's except that they're being pushed back. So market is still expecting the first cut to come in May this year. So if you look at currently the CME Fed Watch 2 pricing, okay, so for sure, if you go scroll down, the one that is in March will be more or less killed off, only 18% chance for the cut to come in March. So if you look at the main one over here, 1st May FOMC, so overall markets expecting 50% chance of a 25 basis point to cut, then 9% we call it odds or chance to have a 50 basis point cut. So you add these two numbers together, we do have a 59% chance as being implied by the 30-day Fed Fund futures, indicating for the first cut to come in May. So it's a relatively high odds in terms of the above 50, despite the fact that we see a slew of Federal Reserve officials erring towards the cautious side of starting the interest rate cut cycle. Then on the other hand, over here, we do have a news by Janet Yellen. So Janet Yellen, he did also mention that, you know, that last 2 weeks, 1 week or so, we do have this panic scare again about last year, March 2023, where we start to see the US regional bank crisis being hit by the balance, their liability side of the balance sheet, and as well as the asset side of the balance sheet as well. So due to we call it push up in long-term US Treasury yield. So this time around, the US Treasury yield did actually rally. It actually remains muted. But however, due to the past 1.5 years of tightening credit condition, banks that has high we call it high weightage towards commercial real estate loans or commercial real estate assets in the balance sheet now starts to face what I call a balance sheet a credit quality deterioration on these assets, that putting a hamper on their profit margin. So yesterday Janet Yellen did mention that that this risk about mortgage non-bank mortgage lenders are also facing the risk as well at the hearing. So potentially, right, what I suspect over here is that it could potentially lead to what I call a slowdown in quantitative tightening. All right, as you know that the US Federal Reserve is embarking quantitative tightening, and given the fact that you know that non-banks US non-bank financial institution doesn't comes under certain purview in terms of regulatory buffer of how much reserve they need to keep as a safety net. So with this kind of situation playing out, if the Fed at this moment in time is no hurry of cutting interest rate at a very drastic pace, all the way down to 1% or even zero, they got to do it at a very slow and steady pace. So to prevent any what I call credit squeeze in the US economy that could impact this non-bank lender due to the risk of what I call commercial property in their balance sheet get deteriorated, the only way to prevent a further squeeze in this credit condition in US is to slow down the pace of quantitative tightening. So that could happen potentially. So Jerome Powell, even during the last FOMC meeting last week, he did mention that the Fed will actually revisit their quantitative program in the next upcoming FOMC meeting in March. So they will actually tell us what are they going to do next in terms of their quantitative tightening program. So something to look out for during the March FOMC meeting. All right. So these are the key events I highlight to you. Yes. So despite that, you know, as you all know that this commercial what do you call it? A credit deterioration that has having an impact on one of the US regional bank, which is the New York bank called Bank. How does it spread to the wider US banking sector in terms of sentiment? So like I mentioned in my 2 days ago daily dose, we could actually use one of the sector ETF to monitor their sentiment. which is the KBE. So you look at my screen over here, the KBE. So what you see in the last 2 days is the daily chart. The price action actually sold off in last week due to that onslaught of that news, that negative news flow. But what you see the last 2 days has been pretty much interesting in the price action. This is the key support level, medium-term support level, the first limit at 42.70. So it actually shaped two bullish candlestick. First bullish candlestick was formed on Wednesday, the bullish dragonfly doji, followed by a bullish engulfing candlestick. The white color body covers the small little black body of the bullish dragonfly doji. So what we could see over here, we start to see two positive price reaction of this support level. So what market is actually implying right now over here is that they do believe that they are confident that the US Treasury do have some measures to actually provide certain backstop to prevent this credit risk from deteriorating in the banking sector. All right, so this is how I infer from a sentiment technical analysis perspective as looking at the price action on the wider banking sector ETF, which is the KBE. All right, so with that, this sum up to what happened yesterday and things that I like to mention that is important in terms of linking the dots. So let us start with the short-term technical outlook first for the major indices. Okay, let's start with the major indices. So we know that the US major indices, except for the Russell 2000, continue to surge all-time high. All right, so even the S&P yesterday managed to touch the psychological level of 5,000 before backing off slightly. Okay, so now let us take a look at the S&P 500. Okay, where is my S&P 500 chart? Okay, let's start from here. Okay, so we'll start with the Dow Jones Industrial Average first. All right, so let me expand my screen so that you guys could see. All right, all good. Okay, so Dow Jones Industrial Average, no change. So yesterday, what it did over here was, so during the start of the US session, it did a bit of a pullback profit taking before bouncing up strongly. There's a V-shaped bullish reversal, as you could see in my screen over here, before hitting that first resistance that we mentioned, keep on mentioning since the start of this week at 38,750. So overall, no bearish exhaustion that's being seen on the daily RSI, the hourly RSI. Pardon me. I mean, it's still hovering above the 50 level mark. All right, managed to also shape a similar higher low. Then after that, being supported by this parallel support as well, parallel ascending support. So no change. I do not want to use. So what we could do is that we could use yesterday's minor swing low over here. Oops, pardon me. Okay, yesterday's minor swing low, which is linked to the previous swing high area, turns to pullback support. So this is like a pullback support level, but I do not want to use this as a pivotal support level because it's kind of too tight. Yeah. All right, at 38,560. So I'll be still using 38,450 as my short-term pivotal support. So any potential pullback that managed to hold above 38,450 still maintain that bullish bias. Above 38,750 sees the next intermediate resistance, which is a feeble extension level of 0.618 to come in at 38,950/38,970. Only an hourly close below 38,450 negate this bullish tone to potentially kickstart a minor corrective decline to retest the support level at 38,200/38,080, also confluencing with the upward sloping 20-day moving average. Nasdaq 100. So Nasdaq 100 over here, very similar price action, but except that it's slightly more bullish because it's managed to surpass this previous range resistance at 17,680. Now turns into a pullback support level. So I do not want to use this level here as short-term pivotal support level because it's a bit tight. So as long as any pullback managed to hold above the 17,500 short-term pivotal support, we also confluence with the upward 20-day sloping moving average should come to add the support in a couple of 1 or 2 days time as well. So as long as 17,500 holds in any pullback, potentially we will still maintain this bullish, short-term bullish outlook on the Nasdaq 100. First resistance to watch is a Fibo extension cluster level at 18,000 slash 18,030. Only an hourly close below 17,500 negates this bullish tone to kickstart a minor corrective decline to retest the medium-term ascending, not medium-term, short-term ascending channel support we drew from the low of October, confluencing with the minor swing low of first Fed, all pointing to the same level at 17,120. So this is the next support level to watch. All right. Now, Asia currency, not Asia currency, Asia indices, Japan 225. So Japan 225, if you recall over here, is that yesterday we were bullish, so we have a resistance to watch at 37,480, which is very close to the upper limit of the major ascending channel, and as well as a cluster of Fibo extension level as well. So this major ascending channel is the channel that's very long term that I drew from the low of 5th of Jan 2023. So now it's approaching a major resistance level at the 37,480 mark level, which was our resistance yesterday for our bullish tone or bullish bias. And what's interesting, as the price shape higher high in the in this price action in the hourly chart of the Japan 225, but what we could see over here is the Japan 225 hourly RSI has started to shape a bearish divergence, okay, going against the trend of the price action. All right, so what it means that this last push up, or not last, but this recent push up of higher high is losing upside momentum. So what we could see, and despite the fact that where it loses upside momentum, it loses upside momentum near a major upper limit of a major ascending channel, which is at 37,480. So with that, there could be a high risk of a mean reversion decline scenario. Like I said, that this mean reversion decline scenario, not a sign of a major bearish reversal of the Japan 225. And bear in mind, we are all our daily dose of market insights are very geared towards short-term technical outlook. So what I mean by short-term technical outlook, we are talking about a time frame of between 1 to 3 days. All right, not 1 to 3 months. Okay, so I need to stress that. That's very important in terms of the time horizon. So so this risk of a potential mean reversion decline could take 1 to 3 days potentially, as long as 37,620 short-term pivotal resistance is not surpassed to the upside. First support level to watch will be 36,880. A breakdown below it exposes the next near-term support level at 36,510. Only an hourly close above 37,620 invalidates this potential mean reversion decline scenario to see the continuation of this potential impulsive up move towards the next intermediate resistance, which is a Fibo extension level at 2 times 2.618, taking from the low of 31st of Jan, project it to the high of 5th of February, extend it down towards the 7th of February minus swing low, you get 2.618%, and within the nested one over here is one time. All right, so it's roughly around 2038 figure level, 120 level. All right, so that's the next resistance if 37,620 is being surpassed to the upside. Then now, Hong Kong index, the Hang Seng index. So Hang Seng index, still recall that yesterday we do have a bullish bias waiting for the pullback. So the pullback indeed takes shape and now managed to shape a bounce at the 15,640 level slash put about excess slash 440, and this level over here also confluence with the minor ascending channel support that I drew from the low of 22nd of January. And right now the RSI also managed to actually hit the oversold level and starts to turn upwards as well. So no change as long as 15,640 slash 15,440. I repeat the number again, 15,640 slash 15,440 maintains as a short-term pivotal support. It's not surpassing to the downside. Potentially the first resistance to watch will be at 16,250, which corresponds to the downward 50-day moving average as well. So all in all, what you could see over here is still a potential counter trend rally in the Hong Kong 33 index that potentially could take shape. And bear in mind over here is today the cash Hong Kong market, it means the Hong Kong stock exchange will be closed for half day. So after that, that means after around 12:30, the market will be closed. So there will be very thin liquidity trading. And do not forget, next week we do have the Chinese New Year break as well. So for Chinese New Year break, the Hong Kong stock exchange, so the cash market, will be closed on Monday and Tuesday. Yeah, Monday and Tuesday. If I'm not Monday and Tuesday, and they'll be back on Wednesday. Okay, just to confirm again on the timing. it should be the case. If that's the case, okay, let me double check for you guys. Yes, the Hong Kong market will reopen again on next Wednesday, which is the 14th of February. But however, the China stock market, the China cash stock market will be closed today. Today, they're going to open for the China stock market, and the China stock market will be closed for the entire week of next week. That means all the way from 12th February to 16th of February, and they will resume trading again for the Chinese as well as the China stock market on the 19th of February. So very likely next week onwards, you will see a bit of thin liquidity trading indirectly that's impacted on the Hong Kong 33 index as well, after, despite even though Hong Kong starts open on the 14th of February next week. Okay, now lastly will be the German 30 index. So German 30 index over here, no change, it's going to churn sideways, but holding above the short-term pivotal support that we have at 16,870. So as long as 16,870 holds, we also confluence with this 20-day moving average upward sloping that coming to act as a support pretty soon. We still maintain that bullish outlook to see it. For the first resistance to watch will be at 17,130, 17,155. Only hourly close below 16,870 will negate this bullish tone to see a slide to 16,795. A break below 16,795 potentially exposes the 50-day moving average that is acting as a resist support level at around 16,700. Okay, so this is the two support level to watch: 16,795 followed by 16,700. If the pivotal support level at this 16,870 is broken to the downside. All right. Okay, so now what we could see over here is net overall, we still maintain a short-term bullish outlook on the major indices that I cover, with the exception of the Japan 225, with the risk of a potential mean reversion decline that is unfolding in the short term. Now, FX market. So FX market, right? If you look at the broad-based market over here, what we could see is that this the 5-day rolling performance as of today is rather mixed. So it's all like a sideways confirmation. So what we could see over here, there's no clear dollar strength as well, and in fact, right now dollar is weakening against the Kiwi pretty steeply over here at this point in time. Then the rest of the currency just heading sideways. So the one that is strongest is the dollar yen. Yes, that is squeezing out. Why? Because there's a technical level that's been taken out yesterday at 48.80. So later I'll share with you the dollar yen level. Okay, so now before we go into dollar yen, let us before we jump into the Asia Pacific currency technical outlook, let us start with the wait, once 1 second. So let us start with the European currency first. So for European currency, right, for the euro dollar, no change. So euro dollar yesterday, right, it came down, hit the near term support level and bounce. So with that, right, we're still using this level here, 10720 as my key short term pivotal support level. Still maintain that short term bullish outlook. First resistance to watch will be 10795. Above this level exposes 1.0840, which confluence with a couple of different technical elements. The upper limit of this minor descending channel that I drew from the high of 12th of January, and confluencing with the 20-day and the 200-day moving average, all pointing to the same level at 1.0840. Right. So this level is pretty key, at least in the short term. However, hourly close below 1.0720 will invalidate this bullish tone to see the continuation of this corrective decline towards the next support level at 1.0665. Then what we have over here is the sterling pound, sterling dollar. So sterling dollar, it came down and managed to survive at our short-term pivotal support, the Titan one we tightened yesterday, which is highlight to you is the 61.8 Fibo level. All right. Yeah, exactly. So whatever bounce off, also bounce off is 200-day moving average. So a bit of V-shaped recovery, minor V-shaped recovery, which is rather positive in terms of the short-term time horizon. So with that, no change for sure. 1.2565 short-term pivotal support to maintain the short-term bullish outlook. First resistance to watch will be at 126.70. Only hourly close below 1.2565 negates this bullish tone to see a further decline to retest the 1.25 figure level. Psychological over here, minor swing low of 8th of December and 14th of December, and as well as the medium-term ascending trend line support that I drew from the swing low of 26th of October last year. Then now let's flip back to the Asia Pac currency, starting with the Aussie dollar. So Aussie dollar no change, managed to test our pivotal support at 64.90 before bouncing up. So what we could see over here is that the RSI also managed to slope upwards after hitting the oversold region, okay, higher low as well. So indicating to us that a bit of upside momentum, at least in the short term, is reviving back into the Aussie dollar. So no change, we use 64.90. So I put a bit of excess on the downside over here, will be at 64.70. So 64.90 slash 64.70 will be our short term pivotal support for today to maintain this short-term bullish kind of outlook. First resistance to watch for sure will be at 65.40. All right, then above exposes 65.70, which confluence with the 200-day and 20-day moving average. Only hourly close below 64.70 negates this tone to see the continuation of this medium-term corrective decline towards the next support at 64.50 and even 64.10 slash 63.90. Now, dollar yen. So dollar yen is the only one that start to see a very pronounced dollar strength coming back. Why? Because technically it broke above a key short-term resistance that that was a range resistance since 19th of Jan at 48.80. Now, yesterday it clearly broke out. So right now, I'll be using this 48.80 as my short-term pivotal support level. Potentially could now see a further squeeze to test the upper limit of this ascending channel that I drew from the low of 2nd of February. Also confluence with one-time Fibo extension that I drew from here, the low of 2nd of Feb, project it to the high of 6th of Feb, extend it downwards towards the 7th of Feb. Then you give you one-time Fibo projection at 15070. So 1520, 15070 will be the next resistance level to watch on the dollar yen. So only hourly close below 14880 will destroy or damage this bullish outlook to see another choppy decline back towards the support level at 14785. We also confluence with the upward sloping 20-day moving average, and as well as the previous minor swing low from 7th of February all the way up to this yesterday Asia session. Wednesday Asia's Wednesday US session that refused to break to the downside. All right, so now gold. So spot gold continue to actually trade above 2015 level. So yesterday it came down and shaped that kind of V-shaped recovery as well. So pretty much positive, at least in the shorter term perspective on the price action. So no change. 2015 short-term pivotal support. Maintain that short-term bullish outlook within this medium-term range configuration that is still taking shape since the high of 28th of December last year. So first resistance to watch will be 2045. Above it, exposes the next range resistance that is in place since 5th of Jan at 2060. Only hourly close below 2015 negates this view to see a messy counter corrective decline to retest the psychological level as well as the medium-term pivotal support at 2000 level. Okay, so the strong push up was the WTI crude oil. So WTI, you see this strong push up. So yesterday we do have a bullish bias at 75.75. So this level has really been surpassed to the upside. So what we could see over here is right now kind of very extreme overbought level on the RSI, almost hitting the similar high over here in 14th of December. So there is a potential risk of a minor mean reversion. So what you could see is that WTI crude oil, right, ever since the high of this level here, let me share with you all. Ever since the high of 15th of November last year, it's been trading in a kind of a symmetrical triangle or ascending triangle range configuration. All right, so right now it's coming very close to the 200-day moving average. And if I do the Fibo retracement of the last push down from the high of 29th of Jan towards the low of 5th of February, it's at 76.4% Fibo retracement, which is so confluence with the 200-day moving average. So I'll be using 7740 level as my short-term pivotal resistance today for a risk of this short-term mean reversion decline to take hold, with the first support level to watch will be at 75.75. A break below 75.75 exposes the next support at 74.20, which also confluence with the 20-day moving average as well. an hourly close above 77.40 will negate this or invalidate this mean reversion decline within a range scenario to see a squeeze up to retest the upper limit of the range resistance at 78.40. All right, so that pretty much sum up today's daily dose of market insights in terms of the cross asset classes technical outlook. So let us take a look at the calendar. What are the things to look out for today? All right, so for today over here, it's a rather quiet day in terms of markets, key economic indicator. Pardon me, a tongue twister. Okay, so for Friday, right? Yeah, this is Friday. So at the European session over here, there's nothing except for you have a finalized inflation rate figure in Germany out at 3 p.m. Singapore time. Then thereafter, we do have Canada. So Canada, we do have the jobs number. They call it the employment change data at 9:30 p.m. Singapore time. So other than that, it's pretty much quiet. Then with the fact that in US, right, today, 9th of February, right, okay, what I see, yeah, okay, so 9th February, the labor statistics of US will start to release new revised figure. So what this new revised figure did over here is an annual thing. So every before the release of the January CPI by the Bureau of Labor Statistics in US, that means next week you will see the release of the January CPI. So 1 week before the release of the January CPI next week, which is today, today on a Friday, they will actually revise previous 5 months or 6 months of CPI data, seasonally adjusted data. All right, so the seasonally adjusted data, sometimes it could actually create a bit of volatility to the market if the seasonality factor is a bit the deviation is a bit wide, so it will impact the month-on-month figure. But however, the year-on-year figure means because CPI data release, there's two. One is month-on-month figure, and the other one is year-on-year. So the year-on-year figure will be not impacted because it's looking into like the month of, let's say, December 2023 versus the month of December in 2022. So it's a 1 year lag. So within this 1 year lag, it's already kind of adjusted itself. It's only the month on month that is being impacted. So something to look out for today as well. Okay, so with that, I as you guys know that this week with the CNY break over here, so I'll be away for a CNY mini holiday for myself as well as my family. So I'll be back on next Wednesday, 14th of February. Yeah, next Wednesday, 14th of February. Then there'll be no daily dose on the 12th and the 13th of February. So with that, I do wish you all a great CNY break. So wishing all of you a great year of abundance, a great year of wealth, and as well a great year of good health in the year of the wooden dragon. So 恭喜发财. Okay, I see you all again on next Wednesday. Thank you.